In 2007, the global economy looked invincible. A shining city of wealth, where money flowed like light through crystal towers, connecting every corner of the world. Banks, governments, and millions of families all believed in the same dream, that this prosperity would last forever. But beneath the surface, hidden deep in the foundations of this financial paradise, lay a secret, a flaw so dangerous it would bring the entire system crashing down. The crack began with something called subprime mortgages. For decades, banks had been careful about who they lent money to, only giving home loans to people who could clearly pay them back. But in the early 2000s, something changed. Banks started giving mortgages to anyone who wanted them, regardless of their ability to pay. No income verification, no down payment, no problem. These were called subprime mortgages, and they were like a virus spreading through the financial system. Every subprime loan was a gamble, and when people inevitably couldn't pay them back, the foundations of the entire housing market began to crack. But the banks weren't content to just hold these risky mortgages. They had a plan to spread the risk and the profit around the world. They bundled thousands of these subprime mortgages together into complex financial instruments called collateralized debt obligations, or CDOs. Think of them as financial bombs disguised as treasure chests. The banks took mortgages they knew were dangerous and mixed them with a few good ones, then convinced rating agencies to stamp them with AAA ratings, the same rating given to U.S. Treasury bonds. These CDOs were sold to pension funds, insurance companies, and banks around the world. Everyone thought they were buying the safest investment possible, but they were actually buying tickets to financial disaster. By 2008, the inevitable happened. Housing prices began to fall, and people started defaulting on their mortgages en masse. But because of the CDO system, these defaults didn't just affect individual banks, they triggered a global catastrophe. When one mortgage failed, it damaged the CDO it was part of. When one CDO failed, it brought down the institutions that owned it. Lehman Brothers, one of the oldest and most respected investment banks in the world, collapsed overnight. Bear Stearns was sold for pennies on the dollar. AIG, the world's largest insurance company, needed a government bailout to survive. The virus had spread from subprime mortgages to the entire global financial system. What started as a crack in the foundation brought down the whole city. But from the ashes of the greatest financial crisis of our time, something powerful emerged. The world learned that true wealth cannot be built on deception and false foundations. New regulations were forged in the fire of crisis, stronger banking standards, increased oversight, and greater transparency. The Dodd-Frank Act, Basel III international banking regulations, and consumer protection agencies were created to ensure that the mistakes of 2008 could never happen again. Like a phoenix rising from the flames, the global financial system was reborn. Not perfect,